And high interest rates are really bad for stocks in general because it doesn't allow them to grow at it cuts their growth exponentially. So if you can borrow money at 2 or 3%, your growth rate's going to be really high. And then if you want to borrow money at 8 or 10%, it cuts your compound growth long term at a substantial rate. So it happens the same thing with us. So like if you want to get a car loan or a house loan, or you want to borrow a line of credit, those interest rates are passed down to us. So it becomes a lot harder for people like us to finance more debt. Realistically, prices should go down because debt's higher to borrow, but we're in a supply chain issue, which is why you've seen houses go up in price and interest rate, and their price isn't coming down because they're not building enough to meet the demand. So it's kind of a double whammy. I think that cash is always considered a bad investment over the last 10 years, and that's exactly why over the next 10, it might end up as a good investment, as bad as that sounds. Because when interest rates go up, like you'll see your checking account might have like 0.3%, and now it's up to 0.5 or higher. So the federal funds rate will raise interest rates, and that will cause an easier amount of money to be returned on cash capital. So it will further lower the inflation by people holding cash earning interest on their cash only. So like equities over the next 10 years will probably have a pretty bad rundown when equities will probably have a pretty bad rundown, but if you allocate your portfolio correctly, you're going to have enough cash on the side or in bonds to be equivalating a higher interest rate. So like bond prices will go down when interest rates go up. So you're going to lose you're going to lose a lot of that initial investment, but your interest rate's going to go up. So that's why bonds are considered a risk-off investment. But when cash is invested, like CDs back in the 70s or 80s, when inflation was really high, were yielding like 12%. Like you could get 12, 18%. There was a time of high inflation, but you had high return on cash capital as well. And I think we're going into an environment where, our interest rates are different now than they used to be already. Like, it's really hard. It's like you don't just want to sell all your stocks and then just flee to cash just because that's what everyone else is, going to do, or you don't want to just go into stock. Like that's why the proper allocation of your like own money, like you work super hard for it, but you want to break it down to where no matter what happens, like if your stocks go down in value, you're going to gain money because you're holding like 30% cash on the side, and that starts earning good interest instead of trash. So like cash, yes, has been trash over the last couple decades, and the dollar will get devalued over time. Like you're gonna lose. Like we already lost 10% of our, like if you have 100 grand saved, you lost 10 grand in purchasing power, even though you still have 100 grand in the bank. It's only worth 90. So you should have spent like a lot of it, or you should have invested a lot, whatever, it doesn't matter. But that's not always the case. Like low interest rates, high interest rates, nobody knows what rates are going to fully do, so you have to be prepared for both sides. So like as stocks go down, it's okay. Like the bonds have been okay. Like they still suck, they've been getting crushed too, but their interest rate goes up. So even though you lose 20%, now the interest rates are doubled up to 100% higher than they used to be, from 1.7 to almost 3 already, or 1.5 to 3%. So yeah, you lost money, but your interest rate increases. But that's pretty much it. The interest rate environment and easy money policy is probably over, but it's hard to tell. We're in a long-term downtrend. I think eventually rates will actually go negative over the long term. Like in the next 40 years, you'll be able to get a 40-year mortgage. I know it's 30 now, but you'll be able to do 40 at 1% or less. That's because they'll need people to go out and spend money. When the economy gets unhealthy, they lower rates. When COVID happened, they jacked down interest rates artificially, and that's what caused the inflation, because everything was shut down, so the government released all that liquidity. They lowered interest rates to keep the economy going through. Now, it saved us the depression, but now we have to we're paying the piper either way. So that's pretty much it. Over the long term, raising rates hurts the long term health of the economy, and then they'll have to lower rates down the road again. It's a cycle, like a market cycle. It happens over and over. But that's pretty much it. I'm going to take Daisy on a ride.